Happy Halloween! This is Craig, the options linebacker. This is the weekend report for Sunday, October 31st. Well, here we are with a monthly chart of the S&P 500 again, and we've been looking at this thing again and again and again over the past few months because this is such an important turning point potentially for the S&P 500. If it can get up and over this next 30 points or so between S&P 1183 and up to and past S&P 1220. As I've been saying, the reason for this, that it's so important, is because right now the monthly chart is in a primary downtrend, lower low, a lower high right here, which means we're still heading down, and you can still feel the influence of this downtrend even though it was 2 years ago. This major section of it, the major impulse wave of this downtrend, people are still scared to death that that is right around the corner again, that we're going to double dip. And while I'm not here to judge whether or not that's in the cards for us, all I'm saying is that this light blue box here is really the difference between continuing with this long-term downtrend or whether we have actually a change of polarity back to a monthly uptrend. It's that important. The potential here is that the low that we had in the July time frame could end up being a higher low. Here's the lower low, here's a higher low, and if the price takes out that 1220, then we have a higher high. So now we have all of a sudden a change in polarity where we're making higher highs and higher lows on the monthly chart. This is obviously significant. Now, we've already made this change in polarity on the weekly chart of the S&P 500. You can see that we were in a downtrend here with lower lows and lower highs, and that changed as we got up and above the 1130 level just a few weeks ago, and then it became higher highs and higher lows. So we've had that change in polarity already on the weekly chart and obviously on the daily chart as well too. Once again, you can see just how close we are to having a major change in polarity on the monthly chart. The prices have got to get up and over that level here, and coincidentally this green line here where the price arrested itself in late April is right around the 61.8% retracement of the entire bear market since October of 2007. Was it really 3 years ago that the bear market started? It seems like it was just yesterday, wasn't it? And that's because of the power of these moves here. They are just so psychologically damaging to everybody that it takes years to shake off the fear of having that second dip again. And that's why we've been climbing the wall of worry here over the last few months, really since the beginning of July and most importantly since the beginning of September. Now, while I currently think that the bulls have the upper hand right now, and they certainly have had for about the past 2 months, we've been going straight up here, about 150 points in the S&Ps. As I mentioned before, we're still in a very, very important level. It's got to get up and over that 1220 level. Now, what would it look like if this pattern were to fail and the longer-term downtrend would kick in again? What we'd see is a fairly decent retracement. In fact, perhaps all the way down to S&P 1130. So we'd see that to begin with. Now that would scare a lot of people. But you'd see a rebound off of that, and everybody would assume, okay, this is just a pullback. Here we go higher again. And if that fails, if the weekly chart then puts in a lower high, then that's going to be a very, very dangerous pattern because it could very quickly lead to a third wave lower here on the weekly chart. This is where it gets interesting because right now, after a 150 point move, you would expect to see some type of pullback in the market, and that's where people are going to start get scared, because if we don't get above and beyond that 1220 level, people might assume that that first wave down is the beginning of something bad. And it may not be. It may be just another wave to stoke up the bearishness, which is going to help propel it above and beyond that 1220 level. But like I say, if that fails, if it does not get over there, if it prints a lower high in the weekly chart, that's when we have to get very, very bearish in our outlook. But only then and not before that. I think a lot of people have gotten very bearish since July and have been literally walking backwards ever since that point. Now, here's what's been driving the market. This is the dollar index, the daily chart of the dollar index. And since the last Fed meeting around September 21st, the dollar has just been falling apart piece by piece. In fact, it's been a systematic destruction of the dollar because what they're doing is they're effectively printing more money, right? And in doing so, they're diluting that value of each additional dollar. And this is why we're seeing the dollar index go down, and because of that, the equity indexes have to go up just to retain par value. Now this pattern, it looked like we had a little pullback here, but we're putting in a lower high already, and it looks like this is ready to roll over again. If we do see this happen in the dollar, that could be the catalyst that helps the S&P break over and above the 1220 level. So that all sounds good, right? Just print more money if you need it and help buoy the economy. Well, the problem with that is that there's always unintended consequences that go along with that. Look at the chart of crude oil, and we all remember this bump that we had in 2008, which was not pretty. I don't know about you, but I don't really look forward to spending $5 a gallon on gasoline again. So this is always a risk here with something like commodities. Anytime that you start monkeying around with a dollar, we could see a very quick rise in crude oil again. And what do you think would happen to the economy if that occurred? Boy, we were in a funk back in 2008. The economy effectively stalled out at that point and really led to, among other things, the big crash that we saw in the fall of 2008. Lehman Brothers was part of that too, but it was a perfect storm at that time, and I hope we don't see that again. But if we start printing a lot more dollars, we're going to see this happen with crude oil. So beware of that. There is no free lunch in this market. Now, going down to the daily chart of the S&P 500, the chart has been stalled out for a straight week. Well, actually almost 2 weeks. It really hasn't gone anywhere whatsoever. A lot of intraday volatility, but in the end, we really haven't moved at all. Why is that? Well, a couple of things. Let's look at the economic calendar for this week. We're having a little party on Tuesday, and we'll know by the end of that day as to whether or not there's going to be a majority or gridlock in Congress. Now, the markets have priced in for about the last 2 months the high probability that we're going to see gridlock in Congress, which has always been good for the markets. Now, the other thing that the markets have priced in has been the results of this FOMC meeting, which we're going to see on Wednesday afternoon, is that what we talked about earlier, that quantitative easing, or what everybody's been calling QE2, coming along. And I think we're probably going to hear a bit more detail on that terse announcement that comes out Wednesday afternoon in terms of just what scale the quantitative easing is going to be. And of course, the market has priced in a relatively optimistic number right now. So back to the daily chart, we have some interesting decisions here. We have 3 weeks left in the November cycle, and we have a bear call spread up here, which means that we want the price to close below this level for November. We have a bull put spread down here, which means we want the price to close above this level. Pretty good probability of that happening. And I would not be surprised at all to see a 30-point pop sometime by the end of this week, just based on the relief of the news coming out with that certainty coming back to the market, which is going to put this trade under some heat. So what I'm recommending to my paid subscribers is that it's a good time to take profits. We've got about 50% profit available on our positions right now. No shame in taking early profits on that. For the rest of them, though, I'm going to hang in on these positions and show people how to actively defend against a move against a credit spread trade. If you sell options, risk management is job number one. We've had titanic volatility for the past 4 years, and I don't see any change in that coming up soon. But don't forget, from volatility comes opportunity. So if you can learn to surf the waves, I think you have a lot of opportunity upcoming. So that's it for this weekend, folks. We'll catch you next one. Enjoy the volatility this week.